The Indian banking sector elevated stress levels, tougher regulations and greater scrutiny. While retail-focused banks have fared slightly better, the corporate-facing lenders have borne the brunt of pain. But rating agency Moody seals a silver lining. The international rating house says Indian banks are stable. Joining us now to tell us what's convinced Moody's that the macro factors won't turn worse is one of the authors of the report, Srikanth Vadlamani. He's Vice President, Financial Institutions, who joins us on the phone line from Singapore. Srikanth, good having you. Thanks much for joining in. Is this outlook of stability on the strength of the economy and a steady asset quality, is it across the board, or are you seeing this only in parts and only in the larger banks?
Sure. So when you look at a title, right, it says on the basis of a good economy and a stable but weak asset quality. So in fact, that in sense captures what we are trying to say. So we are saying it is stabilizing, so things are not getting worsened, but it is stabilizing at a relatively low level as far as absolute levels are concerned. So given that the credit profiles of the Indian banks, particularly the Indian public sector banks, on a standalone basis are already at a relatively low level, that is basically the driver for stability. And even in terms of operating metrics, we are not expecting a worsening. So from an asset quality perspective, we think we are past the peak as far as the recognition is concerned. At the same time, the NPL ratios on an absolute level, as you would know, are quite weak. So we are not really expecting a V-shaped recovery, but it will sort of stabilize at current levels.
Interesting. Srikanth, equity markets by nature tend to think a lot more ahead than what they probably should. Rating agencies, rightfully so, take a look at all the data and then, give a call. My question is, this time around, there's a bit of a convergence in that I hear a lot of large investors talking about how Q4 of the current financial year onwards, you will see a bit of a recovery in the asset quality and the growth numbers for the PSU banks and the corporate-facing banks. Your answer and your report seems to suggest that you believe that would be the case as well. If not Q4, then at least in the next financial year.
Yeah, I mean, we can't take any view on the timing per se because, especially on the corporate NPL side, the prognosis tests on two hypotheses. One is the fact that there will be recoveries that will happen. But while the IBC has helped to have a relatively shorter time frame, it is obviously not happening in line with what was enshrined in the IBC law of the 180 days or the 270 days. So we can't really have a view on the timing, but recoveries definitely will have a potential for surprising and positive. The second one, again, because of which we can't really comment on the timing, is on the power sector, which is, I think, from the entire corporate asset quality puzzle, the missing piece, if I can put it that way. So in the power sector, as far as recognition is concerned, we are not expecting any surprises. So we think all the bad apples have been already identified. The issue is really in terms of what is the haircuts that have to be taken, and the visibility on that is not very high. So that is, again, one more parameter which it's very difficult to put a time frame on, whether it will happen in the next 2 quarters or a bit beyond that. But that, again, would be one of the factors that will determine the extent of the recovery.
About the growth aspect, Srikanth, hitherto the last 4 years, we've seen NBFCs capture a larger share of the growth from the corporate-facing banks, or actually the PSU banks, to be really honest. Do you see that tide reversing in favor of the PSUs and the corporate-facing banks?
Sure. Again, I think I would rather not look at it as NBFCs versus banks. I would rather look at it from a segment perspective. So over the last 5 years, what has happened is that the retail segment has grown much faster than the corporate loan segment, irrespective of which are we talking about NBFCs or banks. Because for that matter, even public sector banks, those who are under PCA and obviously are facing obvious growth constraints, even if you look at their own loan books, the retail growth has been relatively good. I think all of them are at least going at least in the double digits. So it was really a question of retail versus corporates. Of course, there's no denying the fact that even within retail, some banks and some NBFCs were growing much faster than the other banks, and that was in part driven by because of the capital constraints that some of the public sector banks were facing. So it's really from that perspective. And if we take it from that perspective, the way we look at it is that the key benefit to the banking sector will not really come from market share gains as much as it will come from greater pricing power. So especially in segments like LAP, where pricing pricing was on a downturn because everybody wanted to lend to the sector. In that sector, for instance, there is a very high probability that credit conditions will tighten. There is no availability. We don't expect the banks to really step on the accelerator and say that we will supply all the credit that hitherto was being supplied by the NBFCs. Rather, I think what will happen is that they'll use this to leverage upon their pricing power. So banks will benefit, but the channel probably is the pricing power rather than the volume channel.
Interesting. One of the pointers that I believe you've put out on your report is the risk, and which is that rising interest rates represent a bit of a risk. Now, the question mark only is the extent of rates rising, and I don't know if you guys look that much far out or no, but if the Indian inflation numbers for India are anything to be believed, or the Fed's comments recently are to be believed, the pace of rate hikes and the quantum at that too might not be as high as what was believed maybe 6 months ago. How does this piece of the puzzle fit in?
Well, it is positive in that respect that the base level of interest rates maybe they may not, if the factors that you said pan out, then the base level of interest rates will not rise that much. But I think what is also probably equally interesting is how the rate hikes will transmit to the various channels. For instance, going back to my previous argument, on the retail side, in effect, because of this entire NBFC crisis, there has been, in effect, rate hike. Because we have seen, for example, NBFCs hiking rates because they can't supply the credit. We would expect banks also to hike up their rates. So while the base level of rates may not have increased, for certain segments, the spread will increase, which has the same effect on growth as it would have been if it was just a plain rate hike across the sector. So the impact would be sort of a differential impact, and certain segments which are going faster will see a slowdown, and the channel will be through the fact that the cost of credit will increase, irrespective of whether the base level of rates go up or not.
Interesting. Okay, Srikanth, we'll leave it at that. Thank you so much for taking the time out and joining us on such short notice. Really appreciate it.